Portfolio Builder members, we are live. Today is December 3rd. We're up 313% year to date with our high risk growth portfolio, turning every $10,000 into $41,300. Now, the market has pulled back a little bit since we did this update, but this morning, the safe growth strategy was up 1% for December. It's down about 0.5% last I checked. And our high risk portfolio, which was flat this morning's down slightly. And again, this is going to be a screaming buy the dip opportunity. We're on the verge of a stock buyback market melt up dead ahead. Ignore the volatility. We'll talk about what's causing this and why it's unlikely to happen. What's more important is that trillions in new stimulus is about to pass. And the Democratic defeats by the Republican Party in Virginia and New Jersey have lit a fire under their ass to pass spending. What was once told to be a roadblock, having to pass the infrastructure and the Build Back Better combined, was immediately reversed as these races were lost, and the polling for Biden and Kamala have been just falling off a cliff. So they realize they need to pass these budgets while they can, ahead of midterms in 2022. So again, this is their last chance using reconciliation to pass a massive spending budget before the midterms. And I do believe this is going to occur and going to be the catalyst to create an absolute melt up in our portfolio. So we're screaming out loud, buy, get into position. You don't want to be long the dollar. It's extremely overvalued against all other currencies. Trading at 96 on DXY. I expect that to fall back to 89 to tell us when to take profits. You don't want to go to bonds. They are having extremely low yields relative to inflation, with TLT just being outrageous, getting short squeezed up to 154. And it really leaves you with only a few options, which is again, really stocks, commodities, and crypto. So now I have some lines in the sand to tell us, all right, maybe we're missing something. Maybe you want to go along the dollar and the US Treasury market, even though they're extremely overvalued. And so some of these things we're going to be looking at are potential canaries in the coal mine. So I'm watching Tesla, way overvalued. I love Elon, love Tesla. Doesn't matter, it's extremely overvalued, and it is a systemic risk to the global stock market. If Tesla were to go below 800, I'd be getting alarmed. Still over 1,000. Okay, Exxon going sub 64 was a warning sign if it was from a demand shock caused by global lockdowns. Biden said we're not locking down. Germany's refused the lockdown. The new variant is harmless, and it looks like it's spreading through everyone, whether you've taken the medicine or not. This is bullish. This means we're going to get everybody infected with a non-severe case probably in the next 90 days and really be putting this whole sickness lockdown extravaganza behind us. So I see this very bullish for our inflation energy bets. So we don't mind that Exxon's below 64 because we had 5 massive governments come in, including central banks, and do a big bluff trying to get energy prices down ahead of what's almost certainly a multi-year energy crisis globally that's going to also transform into a food crisis. We'll talk about that more. All right, China is something we're keeping a close eye on. We had Alibaba drop 10% this morning. Just a insane. This was at a $300 price on Alibaba, currently trading at 113. That's probably the best deal you can find on a massive corporation in the entire world right now. We have exposure to that. But emerging markets is the index we're watching. It's at 48.89. Below 48 is definitely going to make us get concerned about something going wrong in China. We're at very critical levels on the SPY and emerging markets. I believe we're going to see this melt up and that this volatility is coming to an end very soon. All right, another warning sign would be a retracement of oil, specifically Brent oil below 75. With everything that's been done, releasing strategic reserves, trying to scare the world about a new mutant variant that escapes the medicine. All this, and having central banks coming out and saying they're going to end quantitative easing and hike rates. Barely put a dent on oil, still trading at 69. So not freaking out about that. I expect it to just rocket ship back up and to see oil going above 85 by March. Now, if we saw China's currency crashing, that would be another warning sign, with CNY going above 6.6, nowhere near that. Today it's at 6.3. So we have a few warning signs. The dollar index is at 96. That's above our 94.50 level, but we can explain that Turkey's going into hyperinflation, and so that's what's causing the dollar primarily to go up. So in general, we don't see any reason to change positioning for our members. Okay, so again, DXY is above a critical zone, but it's because the Turkish lira is going through hyperinflation. These poor people have lost half their wealth if they were in the lira, and it is at 13.6. Just last week it was at 12. Pretty soon Turkey's going to have to be bailed out, and it's going to be very bullish for making the dollar index come down, which is exactly how we're positioned to profit. Now, oil has bounced from its recent sell-off, and this was a strategic crash organized by the US and China because they see a massive problem coming our way for the foreseeable future. This winter, certainly, but it's going to get worse as we get back to normal next year. So it was a short-sighted move, and it's been done to help pass these big spending bills, which would be not fathomable if inflation was still roaring hot. We've got Biden officially saying no more lockdowns. And again, I think we're going to be able to call bluff on the quantitative easing ending much more rapidly, like they're trying to frighten us with, and that they're not going to be able to pull off rate hikes. And what was really important today to really make this clear is that we only added 200,000 jobs in November. Okay, that is not good. 500,000 is okay. They need to be printing 700,000 jobs a month all the way through summer in order to pull off hiking interest rates without crippling the economy. And so I just don't think that's going to occur. And we're going to see what happens with the forward guidance at the next FOMC minutes, which is going to happen between December 13th and 15th. I think they're going to backwalk all this talk about doubling down on ending QE and speeding up rate hikes. So we'll see how this plays out. But 2022 is almost certainly going to be met with surging energy prices and life-threatening food inflation globally, and central banks are going to be trapped. Either they fight inflation and send the economy into a Great Depression with massive unemployment, or they ignore the inflation and keep pulling off these little bluffs trying to slow it down while they get their act together and restore labor markets. If the Fed attempts to raise interest rates to fight inflation, an economic crisis will unfold quickly unless they can quickly get back over 5 million jobs that are now gone permanently, potentially, from February of last year when we went into this lockdown mania. So we've got all this data about unemployment going down and yada, yada, yada. But the stark reality is 5 million people have left the US workforce, and they don't seem willing to return. This is going to be a big problem if you want to try to end QE and hike rates, because there's going to be a huge income gap. Now, Goldman Sachs is out predicting 3 rate hikes next year, and that the QE is going to be ended 2 months early. Meanwhile, Morgan Stanley saying that is BS. They're not going to do this ahead of the midterms. All of the rate hikes will likely begin after the December midterms are over next year. So we'll keep a close eye on all of this, and we have the crash insurance in play, but I don't think we need to be freaking out right now. I remain positive that stocks, crypto, and commodities will melt up until most likely the end of Q2 next year. And that's when we're going to be facing the fiscal cliff and need to have massive jobs restored. So if Biden's Build Back Better plan is blocked, which I think is highly unlikely, we could see a stock crash for up to 1 to 2 months, and then they would sneak that spending through. Good news for the Senate is that the debt ceiling was pushed last night with a short-term bill, giving them time all the way through January 15th. So no more debt ceiling crisis to worry about. All eyes are on passing the Build Back Better budget and then seeing if the Fed's really going to speed up QE and accelerate rate hikes. And again, I don't think that's the case. I believe this is all a bluff to try to slow down inflation. Because again, the labor market's just not ready for the contraction in the quantitative easing. A failure to close the deal in December could potentially create a stock crash. And so we have the hedge in place with UVXY, which can return over 1,000% in a very short period of time. Last March, when the market was caught off guard with the Black Swan event, which we did predict for our clients, UVXY went up 1,000%. So if you had a 10% position, that's all you needed to be completely protected. Will that repeat? Well, put this into perspective. That was returned in a 30% decline. The market could now fall 40% and still be above the February 2020 level. So let that sink in. If we go below that February level, we could be seeing a 2,000% plus return in an epic Black Swan event. Now, again, I'm not predicting that's on the verge of occurring. I think that's probably a bigger risk around Q3 of next year. So now may be the best time ever to buy into the high risk strategy and the safe growth strategy. Everything's on sale right now, except for the UVXY position. So we really recommend you get invested. My core prediction remains that we will have a slow motion multi-year rotation out of growth and into value stocks. And this is the cycle we are anticipating to repeat. This is the XLE energy sector. And again, here's the big macro view. After the dot-com bust, it took them about 2 years to figure out what to do, but they did decide to double the deficit spending. So the last cycle, the US government was averaging $250 billion of deficit spending per year, led to the epic NASDAQ bubble and also emerging markets bubble until it popped. They tried to reduce deficits for 1 year. You had a 2-year bear market, but then they switched gears and they doubled down on deficit spending from 2002 to the peak of 2008. We were running at a $500 billion deficit clip and we were suppressing bond interest rates. This caused the energy sector or the value stocks or interest rates to go parabolic. And you had a massive 300% return over a 5-year period. Now, as interest rates rose, eventually it caused the housing bubble crash. This time around, we didn't wait. We bailed out the bankers, gave them a good job pat on the back, and immediately went into a $1 trillion annual deficit spending spree. This was met with even more aggressive quantitative easing to suppress interest rates. Was there volatility? Sure. But if you simply bought and held the energy sector, you walked away with another massive 300% return. And that cycle this time lasted 7 years. Now here we are again with the same agendas, the same policies, and the same group of people in control that ran the government from 2008 all the way till 2016. Climate change, lots of social spending, suppression of interest rates. Okay, it's a big repeat. And that's why we are very bullish on this repeating itself through history right now. What we're anticipating is that when stimulus passes, expect other continents to outperform the US. And that's because the US imports most of its goods and services. So when we go ramp up spending, it's actually very good for other countries around the world. So we're going to anticipate Asia and Europe to go on fire in the stock market and outperform US stocks once we get these budgets passed, which have been held up for quite some time, all year, in fact. Now, the last 2 times we passed spending was with Trump in December for $1 trillion and January for Biden with $2 trillion. You can see emerging markets and European markets went skyrocketing up. Interest rates rose, the dollar fell, and that's exactly what we're anticipating. We're on the precipice of right this moment. So that's the big picture. Growth is going to rotate into value. We're already seeing it. A lot of those stocks that were outrageous during the lockdown years of the last 24 months have now crashed 50 to 80%, anticipating the reopening of the world. Money is flowing into assets that do well with the dollar going down, interest rates going up. Now, here's the entire macro view in a single screenshot. This is all you really need to know to do well with investing and to understand our general strategy with Portfolio Builder. And the yellow line, you can see interest rates rising. In the green line, you can see the value sector, energy, going up with interest rates. And in the candlestick, you can see the NASDAQ went down when interest rates went up. And then as interest rates came falling right back down due to a poor labor recovery and lots of lockdowns and supply chain issues all year, you can see the tech sector went back up, interest rates went down, and energy went down. So our strategy in general is to be long growth, to be long value, and to hedge against a crash with the VIX. And when you have all three of those, it's really hard to go wrong. So we have a trade alert coming out next week. I was going to pull the trigger on it, but decided to hold off a little bit to get more aggressive on that Boyle position. So stay tuned next week for that trade alert. And again, if you want to gain access to our full program, call John right now, 505-610-1334. And so here's what you're going to get when you upgrade. You're going to get access to our membership area so you can see our safe growth strategy. You can just punch in how much money you want to invest, and it will automatically calculate exactly how many shares to buy of each asset. Now, below that is the high risk formula. This is what you're getting on your free trial. So I'll be covering the exact details of how we have our assets allocated and what we're predicting is about to happen a little later in this presentation. But that's one thing you're going to have access to when you do upgrade your free trial. Let's take a quick look at our returns. So the safe growth strategy, boy, is that working well today. If you're heavy in tech, you're just getting eaten alive today. The NASDAQ's down 2.6%. Our portfolio with the hedges in place is only down 0.8% with the safe growth strategy. The high risk strategy is having a little more volatility, down 6%. That's not a big deal when you're up 287% year to date, and you're actually predicting your core investment is potentially going to double or triple by the summer, by next summer. So I'm very bullish. Great day to build out either portfolio currently. Now, some people like to do a blended approach, and currently this blended approach would put 70% of your money in the safe growth strategy, which is a global equity strategy with lots of inflationary hedges, and then 30% into the high risk portfolio. And that makes a very smooth return over time. Now, there's one more bonus you're going to get if you do upgrade, and that's the opportunity to invest in our Rebel Dividends private equity offering. Again, this is only available to investors who have joined our newsletter. That's who gets the opportunity to join this. Now, this was the price per share updated on December 1st. We've had a lot of progress making good relationships with banks so we can get your cash out of the US financial system, off grid into the cryptocurrency sphere. And that's where we see massive opportunity to grow wealth and print out monthly dividends to our investor base. So very good news for Rebel Dividends investors. I didn't have time to update this with the current prices, but on Monday I will. But let's just do a quick review of what we updated in the Rebel Dividends update from December 1st. So the share price was at $1.24. To buy shares, if you wanted to exit, $1.22. We had 1 million shares outstanding with a valuation of about 1.2 million. We've just added around $700,000 this week that's going to be invested, and we're going to be ramping up this into December. This is only available legally from a regulation standpoint to paid portfolio builder members. So just understand that if you haven't joined the program, that's a very nice carrot to join. What we're going to be doing is giving you a lot of different assets that you cannot buy in the stock market. The main ones I'm interested in are Cardano, Solana, Polkadot, Polygon, and now Avalanche is a new one we're going to get involved with. So very exciting. And again, if you look at some of these assets that we're going to be generating monthly income from, they're just outstanding growth assets. So here's a look at Bitcoin over the last few years, up to a 3,400% return. Cardano as high as a 9,500% return. Polkadot, brand new, up to a 1,000% return before pulling back, just getting started. Polygon has had up to a 14,000% return just in the last year alone. And we have a massive cash position we're about to get to work here. So again, this is all coming in. We're now using yield farming to increase the monthly dividend. We've been advertising a 1% dividend. I do think we can get this to a 3 to 5% range by February or March. So very exciting details there. If you'd like to become a Rebel Dividend client, call Victor to book a free call with myself at 505-203-0396. And again, this is only going to be available through December. By January, Dean's going to take all these calls, as I'm going to be very busy doing the investing portion for Rebel Dividends to get that dividend just rocking much, much higher. Okay, we got a lot of chats coming in. Let's check this out. Morris says, should we book profits on UVXY? Nope, didn't do that today. Gary says, why not be in bond? I think bonds are going to crash once the deal passes. Eddie says OPEC is going to increase output. Doesn't matter. Margin calls are coming. Could be an ugly close. Well, yeah, I don't buy it. If we go below 450 on the SPY, there could be some margin selling, but that would be buy the dip. Sarath says, would you trade Rebel Dividends? I do all the work for you. It's a private equity offering, and we pay out a 1% monthly dividend, but I do think that's going to grow to 3 to 5%. We're having really good results being what's called a market maker in DeFi exchanges. And we're doing this on all the different smart contracts. So we've been testing with the Binance Smart Chain because it's so efficient, but we can do this on Ethereum. Cardano is coming in with Sunday Swap. And a bunch more coming in as well. So Avalanche is already up and running. Solana is already up and running. So yeah, we think we can make a lot of money holding the best cryptocurrencies, be the market maker to create income, and dish this out every month. Anita says, I understand you're up 200% this year, but what about people who join? Yeah, so we had our best month in a while in October. November was flat, and we're down 7%. So yeah, you guys need to not have this I need to get rich every single day mentality. Buy the portfolio, look 6 to 12 months into the future, and sit back and relax. That's how we're going to do really well. If you chase whatever is working that day, you're going to end up buying high and selling low. And we don't want to be buying high and selling low now, do we? So yeah, we don't want to buy bonds. I think they're going to crash. Don't want to buy the dollar. It's ready to crash as well. And we're about to pass massive stimulus. So we need to stay put. No changes to the portfolio. As far as UVXY, we have an appropriate level for UVXY until they pass this budget. So maybe once that officially happens, we could look at possibly scaling that down. I wanted to get it closer to 10. So this recent volatility allowed us to do that without a trade alert. Anything below the 8 to 7% UVXY range is just too low when we're so levered up on the long end. So yeah, we need that UVXY. Okay, so If you wanted to book the call to talk to me about Rebel dividends, let me throw that back up. The minimum investment is $50,000. People are asking, what's the guaranteed return? I can't tell you what the future holds, but we're going to be investing in very aggressive cryptocurrencies. I'll be buying out of the money put options on overvalued cryptocurrency related stocks. We've been using UVXY to hedge. I'm going to sell that and start doing out of the money put options on companies that are highly overvalued relative to their holdings. So it's going to be Riot, Marathon, Circle, Coin, and Tesla are going to be the 5 companies I'm going to be doing out of the money put options to protect that portfolio. We will be generating consistent income as a market maker. We're going to be able to give you exposure to assets you just can't get in the stock market. So I do think this is a good addition. It does not replace your high risk portfolio or your safe growth portfolio. So you can use all 3. No, you cannot use your IRA money. You'd have to pull it out. We only accept Bitcoin or bank wire, and it's a 50,000 minimum investment. As far as what we get out of the deal, 2% per year of the share price, and then we're taking 30% of the dividend. Right now, the dividend, and that's only if it's above 1%. We're going to make sure you get no less than 1% dividend. But again, I'm anticipating we get to the 3 to 5% range by February or March, depending on how fast I can get the money out of the US banking system into these different exchanges that we're building the yield farms on. So very exciting. And if you want to book that call, call Victor right now or text him. He does both. Okay, guys, let's go ahead and jump into the meat of the presentation now. Okay, so this is what's causing the market volatility. 100% is you've got the Fed speakers coming out saying the inflation's not transitory. PC says, wait, you get 30%, I get 1. No, I'm taking 30% of the dividend if it goes above 1%. And I get 2% of the share price per year. So I want to make your share price go up so that you hold your position and I can get my 2% every year. And then I want to make sure the dividend is as high as possible because I get 30% of that. And I think we're going to be looking at a 3 to 5% dividend as we can get more aggressive in that strategy. Only forecasting a 1% dividend for January, probably 2 for February, and maybe up to 3 by March. And we're hedging you in a more sophisticated way than just using UVXY. So there's 5 stocks that I believe can provide good value to give an asymmetrical return if there's a crash in cryptos. And that's Marathon Technologies, Riot, Circle, Coinbase, and even Tesla have liquid option markets that are highly correlated to Bitcoin. So that's what we're going to do here soon. And yeah, I would love to get a big crash and buy the dip and then ride it all the way back up. Big picture is governments are trapped, technologies replacing jobs with robots and software. So governments are going to have to continue to print money and devalue their currency, and they're going to have to suppress bond interest rates. Otherwise, the whole thing comes crumbling apart and they lose their power positions in politics. So the growth curve for crypto is most likely 3 decades before we've really hit peak maturity. And just look at how long it took. Look at how long it took for companies like Amazon, for example, to get where they're at. And they're still growing faster than anyone else on the planet. So it's a very long buy and hold portfolio with Rebel dividends. We're hedging you against bad outcomes that would be temporary. The only thing that would really get me bearish on crypto long term would be a miracle turnaround in labor. So if we saw the labor force participation rate going up, that would be great news for your average Joe. It would be horrible news for every type of inflationary asset out there, because it's gonna cause a lot of problems with the way the financial system's engineered. So here's a look at why you shouldn't think that's going to happen. Since 2000, really since the 90s, the US made a decision to let corporations manufacture everything in China, just to really simplify it. And ever since that has been the policy, the standard of living for the average American has been crippled and been falling off a cliff. And so we can see the percentage of people working has been just decimated from as high as 67% and currently at 61. Now, everybody, the media hated Trump, called him all sorts of mean names, but look what happened during his populist agenda. We actually had labor force go up. And so do you think big corporations want to move their manufacturing where they pay Chinese workers $3 an hour and have US workers at $15 an hour? No, they don't want to do that. And so that's what all of this great reset's all about this. It was about what was happening. Global populism was rising. People were demanding higher wages, and corporations do not want to pay higher wages. So we get the Great Reset, and boy, they crushed that whole dream really quick. And so for crypto, if you want to get bearish in crypto, you need to see this going up consistently for a very long period of time. And I don't think that we're going to see that occur. The big picture is we've now created technology that's not creating new jobs, it's destroying jobs. And that's the stark reality. That's why we want to be very, very bullish on cryptos. And again, hedge against temporary times where the central banks are going to try to fight off inflation that they have caused by letting governments run deficits and suppressing bond yields. If the central bank were to step back today, everything would crash. Interest rates would go skyrocketing up. The stock market would go crashing down. Corporations would lay off everyone. So they're just not going to do that for very long periods of time, and that's why we don't have to freak out about it. We have our hedges, and if they want to do that, it will be temporary. We'll cash out the hedges and we will buy the dip. Okay, so let's go ahead. Right now, the market's forecasting that we're going to see a rate hike, and the most likely date has been moved up a month from July to June. So that's what the bond market's telling us. We'll take a look at the curve in a little bit. But this is what is upsetting the market. And now they're starting to get probabilities that there could be multiple rate hikes. Okay, so that's just not going to be fathomable. Now, in these probabilities, we're actually seeing rate hikes beginning in a little bit earlier here, with a 48% chance by May and a 71% chance by June. Okay, so one rate hike may not be too devastating, but you start doing 2 or 3, and you're going to have a big problem unless, again, there's massive jobs coming online. And I don't see that coming. All right, so next, let's look at the yield curve on different time horizons. All right, so in this chart, we have the duration of debt, or how long you're going to lend money to the government, 1 month, 3 month, all the way out to 30 years. On the x-axis. On the y-axis, we have the interest rate, and then we can see the dates. So October 2020 is in black. March 2021 is in green, and then blue is current. So let's just look back at the history here. Here was your yield curve with no stimulus. Okay, then you go past 3 trillion in spending on December and January with Trump and Biden. And here's what you get. You get interest rates skyrocketing up. Now, 2.4 on the 30-year was the magic number to crash everything. So you had tech stocks and crypto take a massive nosedive at that point. And a lot of those tech stocks have never recovered since then. In fact, pretty much just the FANG stocks recovered while everything else has been just crashing for the remainder of the year. Okay, but then we failed to recover labor. We failed to get supply chains fixed, and we failed to pass more spending all year long. And all of that reversed. So we can see the big change here now is the 2-year, which was staying flat, just locked and loaded really low. That's jumped massively. That's what's predicting rate hikes, is that short front end. But the long end is saying, if you dare do it, you're going to crash the economy. And so we can see the short end is saying the inflation is awful. We need to hike rates. On the long end, it's saying, go for it. You're going to crash this. So that's what the yield curve's telling us right now. Now, the VIX structure, we watch every update. We've never seen it look like this now, have we, guys? It's always been going the opposite direction, up like a slope. So the risk area was December, and we're getting that volatility right now. So again, I think we're coming towards the end of that. We're going to pass the Build Back Better. I think December 15th, the Fed's going to say, you know what? We're not really ready to ramp up the end of QE in January. We got to be a little more patient because the labor market was slow. And this new mutant variant is adding to uncertainties in the global economies. We're going to have to wait. That's what we're forecasting at this point. Okay, this is another way to predict rates are going to be a problem for the economy, is looking at reverse repo. If this goes below $1 trillion, and more importantly, below 700 billion, that's going to be our time to reduce exposure to tech stocks specifically, and maybe head more for crypto with rising rates. This is our way to really predict when interest rates are likely going to begin rising. Now, what is reverse repo? That's when banks globally want bonds that pay positive interest to service deposits. And so bonds everywhere are way too low. In Germany, there's negative bonds. So the banks don't obviously want negative yielding bonds. That's not going to pay deposits. So the US is the only bond worth buying to safely pay interest. And they really like those short duration bonds to do that. So they're borrowing them from the Fed. And as long as they're doing that, it tells us there's a ton of money in the banking system, lots of demand for US debt, and we're not going to have big problems on that front. Okay, so here's a look at the markets using those same things. So green is your value, oil and gas, NRGU. NASDAQ is the candlestick, and gray is interest rates. Now in this period, we're actually seeing all three go down simultaneously. So that is not typical whatsoever. And I would not believe that's going to continue. So the other big indicator to follow is oil. Oil is not tanking, even though stocks are. So again, I think this is some margin call liquidity issues, and that the dip will be bought because there's nowhere else to put your money. Here's your Russell 2000 taking a nosedive. It's been trading pretty much flat all year. It had a breakout earlier and then quickly reversed that. Every index is at a critical level right now. So the SPY's at a critical level, NASDAQ's at a critical level, and the Russell 2000, as well as emerging markets. The dollar's at a huge resistance level. I believe these are all going to reverse into passing the Build Back Better budget. Okay, here's your emerging markets. You can see it's been selling off all year as the dollar's been going up, and we've been failing to pass spending. Again, are we going to continue to fail past spending, or are we going to push one of the biggest spending packages in history through within the next month? I do believe they will push it through. The EFO index, we play with safe growth, Europe. also at a critical level, or at least a support level. I wouldn't call it a critical level, still above the levels from January. And again, this one's going to go up with rates going up. It's heavy in banks. That's how we're positioned. A recovery. In this chart, we're comparing Bitcoin to Ethereum. In the safe growth strategy, we have a pretty big Bitcoin play. In the high risk, we have a massive, huge, big bet on Ethereum. And so we can see Ethereum greatly outperforms Bitcoin. Now, also, just to put things in perspective, Bitcoin's worth about $1 trillion, Ethereum's worth about $500 billion. If you go to Rebel Dividends, I'm putting you into Ethereum killers that are valued at 50 billion. So if they even catch up to Ethereum, they're going up 1,000%. If Ethereum doubles or triples and those start to catch up, you could even have a higher return than 10 times. So that's what's really exciting about buying assets that are not yet in the stock market. You can be there before they hit the stock market. And one of our favorite positions is Solana is about to go into the stock market through Grayscale Trust. So you can get in early on that by going to the cryptocurrency exchanges before they list, which is exactly what we're doing. All right, are we headed into stagflation? Well, presumably gold and silver would be the ultimate stagflation hedge, and it's just not doing well this year, down 13% for the leveraged gold play UGL and down 38% for the leveraged silver play. We did exit UGL on Monday. We've held on to a tiny, tiny silver position. If you get labor prints like what we just had all the way into next summer, I bet you get that massive run up in silver, as long as the Fed backs away from this talk about tightening, which I think they're going to do on the FOMC minutes in 2 weeks. Okay, our crash plays. Right now, I think UVXY is the single best play. I don't like the dollar here. I don't like treasuries here. I think UVXY is the single method to hedge your portfolio until we get a reset in rates and a reset in the dollar. So I'd like to see DXY head towards 89. I'd consider hedging against risk by going long the dollar. I'd like to see treasuries retest that low we had last March and potentially break in to higher rates than that 2.4. So that's when I would be happy camper, buying the dip, catching the falling knife in bonds. Right now, I think those are ready to reverse as we pass this spinning. And the only asymmetrical safe return to protect your portfolio is that UVXY, which has been jumping up and down. And again, I don't think we're going to get rich with a huge crash right now. We've all been wanting to see UVXY have its day in the sun, but I don't think that's coming up very soon. All right, we did exit MJ. Continues to just get beaten down. We're long uranium, and I think that's going to be a multi-decade play. Presumably, we're going to have a global agenda to get carbon emissions neutralized by 2050. Only way you get there is with uranium. We replaced TAN, solar, with uranium. I like copper. We're not in that right now. I like rare earth metals better than copper, which is REMX. With the current trends in EV alone, we're going to need to increase lithium output 20-fold. And then cobalt needs another 20-time increase. So there's no way they're going to pull it off. The big tech companies have a massive problem getting enough of these rare earth metals. So very excited there. FNGU was an old play. We got out of it just in time before Alibaba came crashing down. And then the other one I'm interested in is KRBN. We're not holding that yet. That's carbon credits. What they're talking about, if you listen to John Kerry and Bill Gates and all these climate activists, is to tax anybody who creates CO2, that you'd have to buy these credits. So that's what this KRBN index is up to. Now, if there's a populist movement and not a rhino movement in the Republican Party, I wouldn't be fond of KRBN. So that's why we haven't played that. It's looking like we very well likely could have that populist resurgence coming back to life globally next year, and it's going to be pushed by food costing too much. I think that's really going to be the main motivator to get people off their ass and become upset with their government. Okay, so why is the dollar so strong right here? This is going to have to get bailed out. Imagine losing half your money in 3 months, or at least half your buying power. So wow, just insane. Every single thing, and it's worse than that. It's actually far worse than that. They've lost more like 60% of their buying power in 3 months. Horrifying. This has to be bailed out, and it's going to be bullish for markets when it occurs. Okay, is China really going to crash? Their currency sure doesn't say so. Now they control that currency, so we can see pain in the stock market, but it's still at very, very highly valued levels. So outside of Alibaba, they've been popping things on purpose. And again, I think that it's a great buy the dip opportunity to have exposure to Asia. Mary says, I was not informed to sell MJ and F&GU. Instead, I saw it was gone. Okay, I could have been more clear on that. Sorry, Mary. But yeah, if it's not on the trading plan, then that means it's an exit just in general. I'll make sure to make it more clear next time. Okay, here's NRGU. This is our favorite play for the next 5 years. It's very volatile, so just prepare yourself for that. I believe this could be headed towards 600 to 900 outside of splits. So how do we justify that? We got to look at what it's actually trading. So Exxon, this is the big US oil giant that we have exposure to with NRG. We have the top 10 US oil companies. The way the administration has set this up is that existing big oil producers are set to jet. No one else can compete with them, and they want to drive the price of oil up. So that is great for NRGU for the foreseeable future. So unless we think they're going to suddenly stop spending money and running deficits, then this is going to be a very beautiful play. And this company is probably going to make more money per year than it ever has in the history of its company. And so we'll get worried about NRGU when Exxon gets towards the 96 range and probably breaks to a new high. And then we'll also be paying close attention to the dollar. Okay, so let me go ahead and hide the lira. So where do we think the dollar could fall to? I believe it's going to fall back to the 90 range, possibly 89. And that's when we should take short-term profits on all our inflationary plays. So if you jump into bonds in the dollar now, you're probably jumping in at perfectly the wrong time. And those are the only other two investments that you could even consider outside of stocks, commodities, and cryptos. Okay, again, China looks fine. Buy the dip on energy, it's going up. Here's the market cap opportunities. So just look, Ethereum's at $500 billion, Bitcoin's at $1 trillion. They're in the stock market. Everybody can buy that. The ones you can't get in the stock market are what you want to load up on right now if you're looking for huge gains and front running the masses. So we like Binance, we like Solana, we like Cardano, we like Polkadot, we like AVAX, we like Polygon, and that's really the big operating systems that compete with Ethereum. So they all create smart contracts. They all allow you to develop software on top of that. So that's where we see the opportunity. Okay, so here's where this new variant's coming from. Keeping a close eye on it. It appears to be very mild, and I see this as a bullish development. It is getting everybody, everyone who took the medicine, everyone who didn't take the medicine, infected fast with mild symptoms. So let it rip through the whole planet. and let's get this thing going. So yeah, I think this is all good news. No reason to predict lockdowns. The political willpower for Biden to lock down the US is zero. Nobody wants a lockdown. And I don't think they're going to need it to pass the Build Back Better bill. So that's originally why I thought they might consider a lockdown. Now here's Germany. They have locked down the people refusing the medicine. So that's interesting, keeping a close eye on that. We've got some crazy dictatorship running through Australia, New Zealand still. A lot of the most medicated places on the planet, like Portugal, Singapore. Again, it's just nothing stopping this. And countries are not doing the lockdowns that would get us scared. Okay, Marcus says, how do we get the Solana? You'd have to go do that on your own or invest in Rebel dividends. I wouldn't recommend it unless you're pretty good with a computer and more importantly, security. You don't want to lose your coins because you didn't know how to protect them. All right, so here's what I've been anticipating is that this would run up into December and peak out in mid-January, and that this would be when potentially there could be a lockdown risk, and that would be short-lived. So far, it's starting to pick up. We'll see how that plays out as we head into winter. Hospitalizations, we're going to anticipate are going to rise into winter. And again, we're mostly interested if that causes a lockdown or not. Now, here's the chart we've been looking at saying, all right, these tend to be correlated. Interest rates go up, oil goes up. And since April, we had interest rates falling and oil going up. And the first big break was to knock oil lower and rates went lower. But let's think about it. The US Central Bank has been suppressing yields, and governments globally just did a huge theater play to try to get the price of energy down. Will it really kill the demand for oil, or is the demand for oil going to rise and there's a limited supply of this energy? And are the policies of the government going to increase supply or keep it stifled? Well, we all know it's being stifled on purpose. So yes, oil's going up. We have nothing to worry about unless there's lockdowns. And it does not look like the lockdowns are going to occur. Okay, if China's crashing, their economy, copper would be tanking, just not happening. This is why I was saying to not worry about that one-day pullback in the natural gas play we got involved with. Let's review what happened with lumber. So lumber just went outrageous to 1100. So it went all the way up to, to 1700 after trading for decades in the 400 range. So it went up 300%, crashed all the way back to 450, where it typically had high prices, and now it's doubled back up to 900. And so that's exactly what I'm believing is about to repeat itself in natural gas into the winter. So with the high risk, I'm going to be chasing these inflationary bubbles with that fourth position. I like oil for the next few months. After that, we're going to predict skyrocketing cost of agriculture. And I have a few tickers ready to go for that. They're already up a lot. So we'll worry about that. But right now, when I saw that natural gas crash, this is a great opportunity to make a quick buck on that one. And we can see a similar trend with the cost of shipping commodities through the Baltic Dry Index. We went to these parabolic levels. It's cooled off, but it's cooled off at a level that's still higher than we've ever seen in history. So all these price changes are permanent. Is the rate of change going to slow down on inflation? Yes, but we're still going to be living at permanently elevated prices. Okay, so here's the bond market in the US, and here's what we got. We got 2-year going up saying inflation's bad, we need to hike rates. And then we have the long end saying, go for it, you're going to crash the economy if you dare do it. So that's what the bond market's telling us right now. This is the gold to copper ratio, which is good for predicting rates. If we're in a reflation or a recovery, we're going to be using copper to build things. If we're in a dead economy and we're inefficiently spending money and it's not being put to use, gold's going to go up. You're going to have stagflation. So this can give you a feel for what can occur if we can get jobs and a recovery online, which I do think is in the cards for now. So 2002 to 2006, rates went up. And if you were following this gold to copper ratio, you predicted it. And you can get a feel for how extreme this can get. That's why I wouldn't be going all in on gold and silver right now, and why I'm more interested in things we use in the economy. Okay, if any one of these bond markets are tanking, that means someone's losing access to credit or defaulting on existing debt. And it's just not happening. So we've got TLT making it cheaper and cheaper for the government to borrow money. LQD trading flat, meaning your Apple, Amazon can get whatever money they want at a very low rate. And even the worthless junk bonds, even though they have sold off slightly, they're only down 2%. So even the completely insolvent zombie companies who can't even pay their bills without borrowing money every quarter can still get money cheap. All right, this is where we track bond auctions. We're not going to pay too much attention to this until that reverse repo starts to fall, because that means there's just too much demand for debt. I have reduced some of the economic slides for today so we can focus on what's new. Non-farm payrolls came in at 210,000. Now, remember, they did revise these 2 months up dramatically, like 3 to 4 months later, which is bizarre. I've seen some reports that they may be downplaying this report. And the reason why is there's a strong job recovery. We don't need to spend as much money, and we need to hike interest rates. Okay, so the government doesn't want to do that. So they really are incentivized to have weak job data so they keep the money printing going. Okay, banks are finally lending. That's how we're positioned for recovery. Consumers continue to borrow, so no signs of a slowdown in credit in the US. Jobless claims jumped lower here, but are people just giving up? We're not seeing the labor force jump. We did get a little bit of a jump in the labor right here. So, but again, if this path had continued, we'd be at 63.5, maybe 64% labor force. This gap right here represents 5 million people who refuse to go back to work, even though there's 10 million jobs open. All right, canaries in the coal mine on individual names. Apple hanging in there. Tesla hanging in there. ARK funds not looking hot. I guess DocuSign tanked today and they have a huge play in that. Remember, she was predicting $45 oil, and we're not in a bubble. I think we could see this puppy go to the 30 to 50 range. So if you're in ARK funds, careful if interest rates begin to rise. Okay, Tencent holding on. We have exposure to that with EDC. There's all this fear mongering that we're going to delist Alibaba off the US exchange and move it to Hong Kong. And that's, I believe, the volatility. But look at this. The high price was at 318, currently at 112. The decline from peak to bottom now is 63%. That is beautiful. We had Berkshire Hathaway double down, probably tripling down now. That company is a great company long-term. All right, Samsung ended its crash. Good news there. Toyota hanging in strong. So there's really the main warning signs we have are the Fed tightening. I believe the Build Back Better is going to pass. I don't see lockdowns as a risk. The dollar's expensive, but it's because the lira is crashing. That's going to be most likely resolved with the bailout. And so yeah, I see no reason to change our positioning. Okay, PMIs hanging in there in China above 50. China's imports fell slightly, but still at record levels. And I believe they're getting ready to pump money into the economy as the US is preparing to slow down. That's typically what they do. Stocks are highly correlated to the balance sheet. Came down a little bit, but don't worry, that this is going to go up another $500 billion. This is going to end up around $9 trillion. And that's if they do what they say they're going to do, which is end in June. European balance sheet grew. Japan's has been trading flat. So China is likely to come in and start increasing credit. Okay, now we'll look at our live feed here. Within the NASDAQ, 5 stocks account for 71% of the 19% year-to-date gain. FANG stocks. Live Monitor says they won't raise rates until after the midterms. Raising them now would send markets into a tailspin. We're built on zero rates. I happen to believe that, but we will see. They're doing a big bluff right now, or maybe not. Goldman is predicting $85 Brent by early next year. Alibaba did drop as U.S. regulators eye delisting. Again, it would just move to Hong Kong. We already have exposure to companies that are listed in Hong Kong, not U.S. So not the end of the world. We're going to see this variant, its real effects here in the next week or so. It's spreading all over the U.S. I think it's a non-event. Almost everyone who's been identified with it so far was had 2 or 3 doses of the medicine. So interesting there. JP Morgan's Klonovic suggests the variant could be positive for risk and end the pandemic. I do like following him. He's a very smart guy. Stephen Van Meter says good news is now perceived as bad news by the markets. Faster taper is coming. He's slanted towards whatever he thinks will make bonds go up is what he's going to talk about. But I'd agree that the good data would probably in the short term be bad for markets. But good thing we're not getting good data. So Lynn Alden's pointing out that the internet was created in the 70s and the same infrastructure is still used today in regards to Web 3.0 in the crypto sphere. And how long it may take to transition, decades. Okay, so Rebel Dividend is going to be buying these great assets for decades and creating income as a market maker. Okay, they passed a bill last night. Who would have guessed McConnell would throw another free bone to the opposition because he's really on the same team. So that's why we don't want to bet against spending right now. Elon continuing to mess with the powers that be. Let's set an age limit after which you can't run for political office, perhaps a number just below 70. Obviously poking fun at Trump and Biden. Retail yesterday bought 2.2 billion. We are having insiders sell at elevated levels recently. Okay, very good. All right, so let's go back to here. I'm going to be reviewing the exact asset allocation here in a minute. But if you're expired and you're catching this on YouTube, this is where the video ends. You're not going to get the trade alerts, and you're not going to get the exact breakdown of how we're invested in the markets. So make sure to give us a ring, upgrade your free trial, and get all the bonuses. Okay, great. So I'm going to go ahead in that recording.